Hey there, savvy investors, and welcome back to the channel where we dive deep into the unique corners of the market. Today, we're peeling back the layers on a fascinating microcap that has popped up on our hard-to-borrow screener, TGHL. Its situation is truly one of a kind, and it offers a fantastic opportunity to understand what extreme cost-to-borrow numbers can signify, even when the stock is seemingly dormant. Get ready for some eye-opening insights. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about TGHL, ticker symbol TGHL, show TGHL ticker. This is a microcap company, which immediately tells us it's likely a smaller entity, potentially with lower liquidity and a higher degree of volatility if it sees any action. We don't have a specific sector listed for TGHL, which often suggests it might be an obscure company, perhaps at a very early stage, or operating in a niche area that doesn't fit neatly into traditional categories. This can add to its unique profile. What's truly striking about TGHL and why it's on our radar is its phenomenal cost-to-borrow rate. However, before we dive into that, it's crucial to note the recent market activity, or rather, the lack thereof. Today, TGHL has seen 0.0% change with 0 shares traded. The last 5 days? Still 0.0% and 0 volume. The last 30 days? You guessed it, 0.0% change and 0 average volume. This means the public market has been completely quiet for TGHL. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why should you care? Show animation of short selling. When a short seller wants to bet against a stock, they first need to borrow shares from a broker. They then sell these borrowed shares, hoping to buy them back later at a low price and return them to the lender, profiting from the difference. But borrowing isn't free. Brokers charge a fee, known as a cost to borrow, and it's typically expressed as an annualized percentage. High CTB indicates strong demand to short a stock, or, crucially, a very limited supply of shares available to lend out. When this fee skyrockets, sometimes even above 100% like we see, it means short sellers are paying a premium, often a hefty one, just for the privilege of holding their short position. Why this stock is hard to borrow right now. Now, let's get back to TGHL and its incredible CTB. Our data shows TGHL currently has an annualized cost to borrow fee of an astonishing 773.1%. Highlight 773.1%. Think about that, almost 775% per year to hold a short position. This isn't just high, it's extremely high. We don't have information on CTB momentum or the exact number of shares currently available to borrow, but this sky-high fee tells us that shares of TGHL are incredibly hard to come by for shorting purposes. With an estimated float of just 12.7 million shares, this scarcity makes sense. What's truly unique here is that this extreme CTB exists despite TGHL showing absolutely no trading volume or price movement in the public market recently. This suggests an intense liquidity in the borrow market itself. Very few shares are available to lend, which drives the borrowing costs through the roof, even if no one is actively buying or selling the stock on the exchanges. Our internal composite squeeze score for TGHL sits at 46.5, which indicates some underlying potential, but it's far from a slam dunk. Squeeze mechanics explained. So, what does a high cost to borrow have to do with a potential short squeeze? A short squeeze happens when the price of a heavily shorted stock rapidly rises. This can be triggered by positive news, unexpected buying pressure, or even just the fundamental scarcity of shares. As the price goes up, short sellers start to face mounting losses, especially if they're also paying an exorbitant CTB fee like 773.1% for TGHL. To limit their losses, or just to stop the bleeding, they begin to cover their short positions, meaning they buy back shares in the open market to return to their lenders. This act of buying creates additional demand, which can further push the stock price higher, forcing more short sellers to cover, and creating a vicious cycle of upward price movement. The fewer shares available to borrow, the more pressure short sellers face if the stock even hints at moving up. However, it's vital to remember, a high CTB does not guarantee a squeeze. It can also signal that short sellers have incredibly strong conviction in their bearish thesis, and they're willing to pay dearly to stay short. Dilution risk check. One major factor that can completely negate a short squeeze thesis, even with an ultra-high cost to borrow, is dilution. Dilution occurs when a company issues new shares into the market, often through offerings like S-1, S-3, or 424B filings. This increases the total number of shares outstanding, effectively diluting the value of existing shares and flooding the market with new supply. If a company issues a significant amount of new shares, any buying pressure from short covering can be easily absorbed, preventing a squeeze from gaining traction. For TGHL, we have some good news here. Our dilution risk check shows no recent dilutive SEC filings specificus -1, -3, or 424B found in the last 90 days. We also haven't found any recent reverse splits for TGHL in our look-back window, which can sometimes signal underlying issues or be a precursor to future dilution. Alright, let's take a quick break for that important reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given TGHL's unique situation in microcap with an astronomical 773.1% CTB but zero recent trading volume or price movement, what should you be watching for? The key here is volume. Currently, TGHL is a dormant stock in the public market. But if, for any reason, even a small amount of buying volume were to suddenly appear, it could be highly significant. The extreme cost to borrow signals an incredible scarcity of shares for shorting. If even a handful of shares were to start trading hands and the price nudged upward, the pressure on any existing short sellers who are paying that massive CTB could become intense very quickly. Our squeeze score of 46.5 suggests a moderate potential, highlighting that while the borrow market is incredibly tight, there isn't yet the momentum or trading activity to push it higher. Watch for any indication of increased trading activity or price movement. TGHL presents a fascinating case study in the world of hard-to-borrow stocks. It's a microcap with an absolutely wild cost to borrow of 773.1%, but an almost completely quiet public market with zero recent volume. This combination highlights that the scarcity of shares for borrowing is extreme, even if there's no active trading interest right now. It's a reminder that a high CTB is a powerful signal of underlying scarcity and potential pressure, but it takes actual market catalysts to ignite a squeeze. As always, do your own rigorous research before considering any investment. If you found this deep dive into TGHL and the mechanics of how to borrow stocks insightful, please hit that like button, subscribe for more unique market breakdowns, and let us know in the comments what other stocks you'd like us to analyze.